Welcome to the Invest with Clarity podcast, where you will learn how success in investing, as in life, is the result of absolute clarity. Mark Pearson of Nepsis in Minneapolis, Minnesota, shares his passion for portfolio management and commitment to transparency and communication to allow investors to fully understand what they own and why, bringing them to clarity in their investments. And now, here are your co-hosts, Matt Halloran and Mark Pearson.
Hello and welcome to another Invest with Clarity podcast. I am your sort of host, Matt Halloran, joined, of course, by Chuck and Mark. Today is part one of a two-part mini-series, and we're going to talk about what the industry says, but truly what clarity proclaims. All right, Chuck, I'm going to let you take it away.
Okay, Matt, thanks for the great introduction. And Mark, I have been looking forward to doing this one for a long time. So let me just set the table for our listeners here. We have 10 truths. So what we're going to do, we're going to play a little game here, okay? So I'm going to say, which in most of them you're very good at. So that's why I think you're going to excel at this one. So I'm going to say to you, Mark, our industry tells us, and then I'm going to make a statement. And then I'm going to say clarity, on the other hand, proclaims, and then you're going to finish the sentence and the thought and what we at Nepsis actually employ in our investing process. So how does that sound? Is that okay?
Sounds like a fantastic game.
Truth number one, our industry tells us that we invest in the stock market. Clarity, on the other hand, Mark, proclaims.
Wait, don't we invest in the stock market?
No.
Oh, actually, clarity, on the other hand, not only proclaims, but it's also the truth, which is most important, that we
Correct.
are business owners, a collective group of companies via access to the greater capitalistic tool ever invested. In other words, as I tell investors, you don't invest in the stock market. The stock market is nothing more than the greatest tool ever created to bring buyers and sellers of businesses together. That is the fact.
Mark, excellent. So you nailed the first one. I'd like to just stick on this if I could, because you and I spend a good part of our day perusing, if you will, across the various business channels. And I haven't done this, but I would love to tally the number of times, at least we'll call them individuals in the press, ask questions of our contemporaries. What do you think the stock market is going to do today? How is the market going to process this? And it's amazing how if you repeat even something over and over again, which is a falsity, the people end up believing it.
Well, it's kind of like politics, whether you're a Democrat or Republican. Of course, we don't talk politics on this show, but for the area of which I lean towards in my political viewpoint, I spend just as much time, if not more, listening to the side I don't agree with. And I think that in order to be educated, in order to have balance, and in order to have a reasonable discussion, not argument, about a viewpoint you have to know both sides of the story. So why do I say that? Well, you are correct. I peruse the business channels and I can't believe the crap I got to listen to. But I have to, because it's part of my job. And some of the stuff that comes out of people's mouths is shockingly embarrassing. And it's like going to the dance school of tap dancing. I've never seen so much tap dancing in my life. It should really be considered a musical program, not a business program. And of course, I say that with a touch of sarcasm. By the way,
Yes.
I came back from vacation, so my energy level is a little bit high, and I'm feeling a little bit sassy today. So, yes. What blows my mind is on the business channels, how many different people they can bring on who say the exact same things in a little bit different twist, and then say to themselves, gee, I'm pretty dang smart. Remember that common sense is uncommon. And I don't listen to a lot of well, I shouldn't say I listen to it all. I listen to the good and the bad. But what I do is I adhere to the process that we've utilized that's allowed our investors, our clients to be successful over time, which is, of course, investing in great businesses and using volatility as an opportunity to continue to invest in those great businesses over time.
Mark, you just led me into truth number 2. And by the way, en fuego, my friend, you are doing excellently as usual. But even a little bit, you got it. So certainly.
I learned that.
Exactly. That's why I said en fuego. So, okay, let's go to truth number 2 here, because you just led us into it. Our industry tells us that corresponding changes in the price of great companies is to be shunned. We call it, or they call it, I should say, risky and volatile, and have created an army of overpriced and bubble-wrap products to appease this, here's the key word, concocted fear.
100%.
So here it is. You got it. So here it is. Clarity, on the other hand, Mark proclaims,
look, these changes in the price of great companies is nothing more than an opportunity to invest in great businesses at lower prices. We own great companies, and it's not only a good thing, but it's essential in reaping the benefits of wealth creation, because volatility enables you to buy something at a lower price, which eventually allows you the opportunity to sell a portion or all of that business at a higher price down the road. At the end of the day, the average correction on an annual basis, correct me if I'm wrong, from peak to trough is 14%.
Exactly, on an annual basis. You got it.
On an annual basis, most people don't realize that, 14%. You can never buy at the high or buy at the low and sell at the high. If you do, you're lucky. Okay? It's happened for us, but rarely. And so volatility, i.e. waves, are created to take advantage of increasing the potential for wealth long-term by buying more shares of that company at a lower price. And as I've said many times before, 2 things that are very important for the listeners to understand. Number 1, you don't make money or you don't lose money until you sell an investment. So
absolutely,
the appeasement of looking at the daily value, monthly value, or annual value of your portfolio, frankly, I'm not going to say it's futile, because I think it's important to know what you own and look at your portfolio occasionally, but look more at the quality of the businesses you own, and look at over time how at Nepsis, look at how many more shares you own over time by the companies that were on sale that we bought at lower prices. Volatility creates opportunity. Clarity is the foundation that enables an investor to stick to the process and create that long-term wealth.
Boy, Mark, you nailed it on that one. And we've talked about this before we get to the third truth, is the products that our industry have created to push aside what is something that is beautiful, as you just laid out, which actually are these swings in prices. If we didn't have that on a daily basis, you would be really, I would say, handcuffed in the way that people could accentuate returns. And you always use the word, it's not only good, it's essential, meaning we call it volatility. Yeah.
But the reason why people, and the reason why the media, look, this is simple. This is common sense. Financial programs make a lot of money in advertising. Okay. That's how the show stays on the air. How people are paid is by the advertising dollars that come in. Okay.
Yep.
Therefore, in order to sell quality advertising dollars, a financial program has to do things that engage people to watch their program so that they can see the commercials and they can make revenue off the commercials to keep that program on the air. This is common sense. Listen, if you disagree with that, you can go ahead and email mpearson@nepsisinc.com. I doubt I'll get any emails on that one. Okay.
So you certainly will not.
So the financial programs are incentivized to get you to stick to their program. What is the one thing that will get people to turn in to a financial program?
Fear,
uncertainty, and doubt.
You got it.
FUD. Fear, uncertainty, and doubt. And so understand you're at a disadvantage when you turn on the financial program, that you're going to get access to education information. Some is information, some is education. A lot of it is prognostication, postulation, and speculation. And it's designed to sell more commercials at the end of the day, folks. That is the bottom line. Clarity cuts through all of the noise and allows you to take a different perspective. And that perspective is that of a business owner. If the revenues, and we got business owners who listen to this program, if your revenues go down 20, 30, 40%, financial crisis, COVID, other events that have caused massive stock market correction, do you just sell your company right away and walk away? No.
Absolutely not.
What do? You literally continue to invest in your company. You make cuts where you think you need to make cuts, and you make investments in areas you need to make investments because you know the economy is going to eventually turn around. And you want to be prepared for the turnaround in that economy. That's exactly what you should do with your portfolio of businesses you own. You are a business owner. You can't do that, though, when you own a bunch of mutual funds and a bunch of exchange-traded funds, and you end up owning, if not hundreds, but thousands of companies in your portfolio. Period.
Mark, superb. And I just want to give a shout out also to Matt, who stepped in and said fear, right? And then you came back with, which is going to be truth number 3 here. I love your trifecta of prognostication, postulation, and speculation. And we're going to get into this. So here's truth number 3. So take a deep breath. Yep. And you're ready to go in this one. Okay. Our industry tells us the really good investment companies actually have experts that can foretell the future. Their intellectual prowess is connected to their ability to predict the outcomes on a year-to-year basis. Clarity, on the other hand, Mark, proclaims, take it away.
Exactly what I just said in the last one. It's foolish to believe anyone can predict the future no matter where they are employed. If they could, I have news for you. They wouldn't be on the TV program.
Yes.
They'd be sitting on a beach somewhere and eating bonbons and drinking pina coladas. These people are, you love this word, charlatans.
Yes, I do. Charlatans.
And no better than the guy at the county fair guessing people's weight. Fact. Again, prognostication, postulation, and speculation doesn't get you anywhere. My other favorite line, armchair quarterbacks.
Yeah.
Armchair quarterbacks. I've never met an armchair quarterback that was wrong. And considering the fact that they're always right, they're the most underpaid quarterbacks ever in the league.
Oh my gosh, you're leaving me speechless, my friend. You are just nailing it.
Should I go on vacation more?
Yes, that was excellent. You know what I want you to tell our listeners too, as you take again another breath, as we stick on truth 3, is you have published, and I love this because we went back to 2014, Mark. We started out with only 10. We still do it, our annual predictions. And I wish I had this up on the screen. I don't. You last year, because we got into the 2020s, the last couple of years, did 20. And they were just beautiful. And do you remember when you set these out, one person sent you an email. Basically, these aren't predictions. And he played right into our hands. So talk a little bit about that. I know you don't have all 20 memorized, but talk a little bit about some of the things that are for sure going to happen in 2023 in the markets.
Well, this guy, I think it was 2018 or 19 when he emailed me. It was back when we used to do the radio show.
Yes.
Investing for Success. And he sent me an email, said, these aren't predictions. And I said, well, what are they then? He said, well, they're statements. And I said, yes, of fact, but they're still predictions. I'm predicting, I am suggesting that these things are going to happen. He couldn't wrap his arms around it. He wanted me to tell him where the S&P 500 was going to end up at the end of the year. You know, my predictions are predictions, but they're also statements of common sense.
Right.
Like, people will continue to listen to predictions throughout the year and never go back to actually compare the prediction to actually what happened. We live in a world of immediate gratification. Many investors are emotional. They are not strategic. And so when you don't have clarity, you can't be strategic. So you fall back on human nature, which is to be emotional. This is the ultimate power of clarity. This is the understanding that when you have an ability to either know or can find out the businesses that you own in your portfolio, and not only that, look at the activity in your portfolio to see what you've bought and sold in that process. Only then can you assess really how powerful volatility and clarity is in your portfolio.
Man, absolutely. Another clean sweep on that one. We got 2 more to go here, my friend. You think we can accomplish the 5? I think you're right.
That. Well, let's give
Excellent.
it a whirl, Chuckles.
Okay. You're going to love this one. So, Mark, our industry tells us for us to be satisfied with the returns of the companies that we own, that we must do better than some arbitrarily created so-called benchmark. Clarity, on the other hand, Mark proclaims,
any benchmark or index is a Trojan horse that is wheeled to pistol whip investors into a state of despair. Comparison is the thief of all joy. I've often said that financial advisors in the industry uses benchmarks to justify their job.
Yes.
Because the reality is most financial advisors are not money managers, they're asset allocators. Now, asset allocation is extremely important. In fact, it is the most important aspect of your portfolio. It's like any business you own. If you only sell one product, you live and die by the success of that product. But if you're a company that has multiple products and enough that you can manage, and you own those products to level out the long-term performance of the profits of your company, that's called product asset allocation or product allocation, i.e. asset allocation. And so the asset allocation of your portfolio is most important. By owning the businesses in an asset allocated manner, not everything goes up the same way at the same time, and not everything goes down the same way all the time. And so clarity, flexibility, and transparency allow you the ability to take advantage of volatility and buy more of a great business on sale.
Absolutely. And I love the way that we here at Nepsis have 2 properties that actually allow performance to be birthed, if you will, and consistent over time. It's that conviction and consistency of a process that actually unearths those businesses. So here's what I want to lead to another question here, Mark. And we don't do this. We're not trained to think this way. When somebody's evaluating a manager, the first thing they want to say, well, what is your past performance? Even though we're required by law to put in a disclaimer that past performance is not indicative of future results. So here's my question. Why don't advisors or clients ask something like this? Tell me that your 2 favorite companies that you own in the portfolio, or tell me 2 that you just sold and why. It would actually, if we viewed the world that way, you could get a really good feel for the conviction and the consistency and how a manager actually selects companies over time.
Well, if you look at a lot of mutual funds and ETFs, you'll notice that they're top weighted.
Exactly.
Holdings are top weighting. Over 50% of the portfolios in those top 10 holdings. The problem is when you add 10 more ETFs to it, you've diluted yourself down from the purpose of the actual strategy of the asset allocation. Okay, that's number 1. Number 2, I use the old cocktail party analogy. You go to the cocktail party and you'll never lack hearing someone brag about a stock they bought and how much money they made. But you'll never hear a person talk about the bad stock they bought. In other words, this industry has created a bunch of people who like to put lipstick on a pig. At the end of the day, people like to sell the shiny stuff. And the reality is that the reason why we don't publish returns is because the success of a portfolio is not contingent upon historical returns. It is contingent upon the process to which you buy decisions and sell decisions. We call it buy discipline and sell discipline. The fact that people ask what historical performance is in the industry has forced people who publish returns to say past performance is not indicative of future performance is a travesty, because at the end of the day, investors really don't know what other questions they ask. And so they ask the simple questions. They ask the ones, well, how have you done historically? And I always say to people, look, we've been around almost 28 years. Do you think we really do a bad job if we've been around 28 years?
I mean, love it.
Honestly. Right?
Exactly.
And we're growing, right? So we're clearly not doing something wrong. So the fact that people look at past performance is the fact that they don't have clarity. They don't know what they own or why they own it, and they don't know what else to ask. I will often ask a financial advisor, tell me the largest holding in your portfolio.
Yeah.
And they don't know. If you can't tell a client what the largest holding in their portfolio, which means the one position that has the greatest amount of risk short-term to your portfolio, then you shouldn't have your money with them. Then they don't have a level of clarity that enables them to make the best decisions possible to put you in a position to potentially have the greatest amount of success you possibly can.
Boy, you nailed it, my friend. And a perfect example, we won't name the company, but our number one holding and what happened today, right? Again, any advisor or money manager better know that, and they better know what's going on and whether the long-term fundamentals of a company have changed or not.
100%.
You got it. Okay. 100%. All right, my friend, we got one more. You got one more in you here?
Let's do it.
Okay. This is another, by the way, just for our audience sake, Mark has trained me on these truths as we've known each other over the last 20 years. So I love this one because this was one. Yes, thank you. I have, thanks to you. And I've learned this one from you too. So I love this. So here we go. Last one. Our industry tells us we must follow a whole host of economic indicators so as to tell us where stock prices will go. Clarity, on the other hand, Mark proclaims,
equity prices tell us where the economy is headed and is the leading indicator, folks. Everyone's talking about recession, mild recession, deep recession. Are we going to have a recession? Are we not going to have a recession? Newsflash for our listeners. Statistically speaking, stocks actually start moving higher 6 to 9 months before the recession. Stocks begin moving higher 6 to 9 months before the recession hits.
Exactly.
In other words, stocks are a leading indicator. Businesses are a leading indicator, not a backwards looking,
right, or a lagging. And and how reverse is our industry in the way they look at this? Every single piece of data, whether it's CPI, unemployment, all of them lagging, are supposed to give indicators as to where prices of a business are going, when really, if people understood the fundamentals of their underlying business, those people who run it know a lot more than those lagging indicators show.
Well, let's take a different perspective, shall we? It's a very competitive business, that advertising business. It's very competitive. Internet advertising, TV advertising, magazine advertising. Advertising, the fight for advertising dollars is extremely competitive. And so, like any other good business, you have to differentiate yourself from the competition to have success, which means when you turn on the financial news channels, they are going to talk about things that they believe will sell the most advertising dollars. It's that simple.
Boy, excellent. And Matt, I think we're going to end on that note. What were your thoughts on this podcast, Matt? I'd love to hear it. Don't you think Mark did another bang up job?
Yeah, he's okay.
Okay.
No, so there's a lot here, and honestly, there's just, once again, guys, there's so much misinformation out there, and the perspective is so skewed on what is really going on. And I love when you do, like, first off, I love when you guys do two-part stuff, because you get deeper into the weeds and really get into explanations more. So I love that. But number two, I love that you guys are challenging the norm, or what people think is the reality, when we know it's not. There's a fundamental different reality to what investing is, and it all starts with investing with clarity. So I thought it was fantastic. It was always fun. I was doing lots of thumbs up, knowing that people can't see me, and doing a lot of giggling, which I'm glad I actually had my microphone off for that, because, that's the last thing anybody wants to hear is Matt giggling like a schoolgirl. So with that, everybody, listen, very quickly, if you have not subscribed to this, please make sure that you do. If you know anybody who needs to hear this reality check of what's truly going on with their investments, and how they should really truly be thinking about this game that we all play, please make sure that you share this podcast with them. It's very, very easy. All you have to do is click that share button. So for Chuck and Mark, this is Matt Halloran. We'll see you on the other side of the mic very soon.
The content discussed is for informational purposes only. It is not a solicitation or recommendation for any securities that may be mentioned herein. Advisory services offered through Nepsis Inc., an SEC registered investment advisor.